Stated earlier, the price to earning multiple needs to be taken into account in conjunction with the earnings growth. And here it becomes important to understand the relationship of the ROIC and the cost of capital, the return on invested capital and the cost of capital. If the company is able to sustain a positive spread of the return on invested capital and the cost of capital for over 5 years or 10 years, this period we tend to call as a comparative advantage period or a CAP, the comparative advantage period. If a company is able to sustain a higher comparative advantage period, that is, a company is able to get a higher return upon the actual invested capital versus the cost of capital, the price to earning multiple will be higher. The price to earning multiple will expand, because if the company is able to sustain this advantage for a longer period of time, much of the value will arise from the company's terminal value. The terminal value or the present value of the terminal value shall be much more higher versus the present value of the future free cash flows. Because much of the valuation in case of the forward price to earning multiple comes from the terminal value and not just the steady state of business. Here also we need to understand is, if a business is constantly growing but the spread between the ROIC and the cost of capital is negative, in that case the business might be destroying value. The business might get liquidated, the business might have to go for dilution to raise cash. In this case, the business should stop doing reinvestment and should distribute everything as dividends. Thus, we cannot look at a price to earning multiple just based upon like one single number. A price to earning multiple can be a value creator, it can also be a value destroyer based upon all these metrics. Also, one more thing that many people tend to do in the market is they tend to compare the current price to earning multiple or the forward price to earning multiple with the past 5 years averages or 10-year averages. It makes no sense. Last 5 years, last 10 years, the cost of capital was different. The risk-free rate was different. The betas were different. The ERPs were different. The equity risk premiums were different. The macro situation was different. The micro scenarios of many companies were different. So how can we compare the current scenario or the forecasted scenario of the company's valuation based upon the past 5 years averages? Because a price to earning multiple in a simple sense cannot be decoded. A price to earning multiple in conjunction with all these parameters can simply become a value creator or a value destroyer. And that is why it's important to understand the price to earning multiple and its relationship with all these factors instead of just looking at this multiple blindly.